Morning all. Just a quick video there to talk about contingent liabilities, in particular the contingent liability from the 2002 question that we did last week and that we're going to finish off today. This is just a general note about it. I'm sure you've read about it in the exam papers, in the textbook, but also I know we came across it in some other question there over the course of the last year, but just to go over it one more time anyway for everybody's sake. So I'll read this particular contingent liability first. It says, on the 12th of the 12th, 2001, the company received a letter from a former employee who was dismissed on the 1st of the 10th, 2001. The employee is claiming compensation for unlawful dismissal. The company's legal advisors believe that the company is unlikely to be liable under the terms of the employment contract, and they estimate the maximum amount of liability will be legal costs of $25,000. Okay, so, excuse me. Here's the thing. A liability for a start is money that you owe, essentially. And a contingent liability is money that you may or may not owe. It's dependent on some other circumstances. So it's contingent on something else happening. So here we can see an example of it. Depending on how they get on in court, they may or may not owe some money to this disgruntled employee. Okay, so there's two ways of dealing with contingent liabilities in published accounts and in accounting generally. Throughout our course, if we come across it in a different question, we'll still do the same thing as we would do in published accounts. So the rule is there are two different types of contingent liabilities. There are contingent liabilities that we think we're probably going to have to pay out for, and there are contingent liabilities that we think that we're probably not going to have to pay out for. So in this case, this is the one that, where is it? The company, the legal advisors believe the company is unlikely to be liable, which means we probably won't have to pay out that money. Okay? So the rule is, when we think that we probably won't have to pay the money, we don't have to enter that information anywhere in our accounts, neither the profit and loss account nor the balance sheet. So that's why we can essentially forget about all of this when we're doing our profit and loss in our balance sheet. However, if there is a contingent liability, even though we don't put it in our accounts, we have to write about it in a note to the account. Okay, and in this case, they ask you for that note. So you have to write about it in a note to the account, and you have to provide certain information in that note. So the information you should provide is information about the nature of the liability, so a description about how it came about. In this case, it's for a claim for compensation for unlawful dismissal. There should be in the note also a mention of the amount you're likely to be liable or not likely to be liable for, but possibly liable for. And there should be also, they say, an opinion about it. So an opinion, in other words, whether or not we're going to be liable or not. In this case, our legal advisors say that we're unlikely to be liable. That's the opinion. So those three things have to go into the note to the accounts. Okay, so that's if it's unlikely to be for us to be liable. If it's likely that we are going to have to pay this money, then we must put it in our accounts, and we must also have the note. So the note is the very same, whether it's likely or unlikely, but in the accounts then where we would put it would be this costs, whatever costs we'd be liable to pay out would go in with ordinarily our administration expenses. Sometimes it would be I suppose it could be either one of our expenses, but mostly it's the admin expenses is where it would go in. So you'd have to put that in there, because it would be, even though you may not end up paying it out for a year or two after the court case is settled, it would have been for something that happened during this year's accounts. So if you think you are going to have to pay it out in the future, then you put it into this year's expenses. So you will put it in the admin expenses. That's the first place you put it. Then also in the balance sheet, you would put it in under the in the current liabilities in the balance sheet if you thought you were going to have to pay it out within a year. And listen, I've never seen one where the advice was where you were going to have to pay it out in more than a year, in which case you'd be putting it into those long-term liabilities, the amounts falling due after more than 1 year. But I've never seen that come up. So anytime it's ever come up in the Leaving Cert, one entry in the admin expenses, one entry into the current liabilities amounts falling due within 1 year. Okay.